Good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. My name is Damaris, the Head of Brand Marketing and Communications at Genghis Capital. We're all smiling because deep down we know Churchill has been listening to classical music. So good spotting, Victor. We're so happy you could join us this Monday morning. We're going to be reviewing the macroeconomic developments of last week, as well as fixed income, that's Treasury Bills and bonds, as well as equities. Then hopefully we'll have Matthew Kabire of EGM Securities also join us. Matthew is going to talk to us about the opportunities in the global financial markets. The Genghis Weekly Investor Briefing is interactive, so please feel free to use the chat box as you've seen Victor do. And if you have a question, please feel free to send it to our panel of experts using the Q&A tab. At the end of the presentations, we're going to tackle every single question and make sure that we set you off the week in the right way and that the trading recommendation is clear. So I believe we're ready to start. Churchill, over to you and your team.
Thanks, Damaris. Good morning to everyone. Happy belated Father's Day to the fathers on the call. I know Damaris was to send some gift hampers to all the dads on the call. Or was it just Genghis dads only, Damaris?
You're going to do a musical performance for all fathers as a father yourself, a father of two.
Why are you putting me on the spot, Damaris? It's too early. Let's get to the end of the day. So I'll walk you through the macro and fixed income bits before I invite my colleagues to discuss the equities bits. So starting with last week's review, basically still on this theme of the budget for the next financial year, we saw what happens is after the CS presented the budget highlights, there's some processes that happens in the National Assembly. So that also played out last week. So just a recap of the budget estimates in the run-up to that budget presentation by the CS. The overall budget expenditure was what you are seeing on the left side of your screen, the expenditure, that's around 3.64 trillion shillings. Whereby there's an allocation to the national government, 1.945 trillion shillings, what is going to the counties, and also what is called the consolidated fund services. And how to fund the budget is what you're seeing on the right side, the revenues and total financing, whereby we have total revenue at 2 trillion, we have grants at 62 billion, and then the gross financing inclusive of net financing and also the redemption. You note that the redemptions are appearing on both sides of the equation. So ideally, why we brought it this way is because at some point you hear that the budget was around 3 trillion, at some point you hear it's 3.6 trillion, but basically it's just netting off the redemption. So even if you net off the redemption, we'll get to around 3.3 trillion thereabouts. 3.04 trillion on both sides of the equation. So there are two ways you can look at the budget. You can either have it as it is, this 3.64 trillion, or you net off the redemptions, but still, there are still two ways to look at the budget. And yeah, ideally, the focus is on the national government estimates at around 1.945 trillion shillings as per what the CS presented. So last week, we saw that the Committee of Supply, so it's the committee that sits to relook at the budget estimates and give its amendments if necessary. So what they recommended, or as per the estimates that were recommended last week, the estimates to the national government came down slightly by 3.6 trillion to 1.942 trillion to the national government. So the effect of this is, if you look at the net financing, it had to come down. Remember from the previous slide, it was 933.4 billion. And because of the decline, so even the net financing has to come down. Total revenue wasn't affected, grants is not affected, but what is primarily affected is now net financing. So it had to come down to 929.7 billion. If you remember correctly, this is the number that the CS presented as the total net financing in the next financial year. So it's just, it neatly fitted within this budget framework that net financing is not supposed to be above 930 billion. So it's just a corrective amendments that were done over the course of last week. The split is net external financing is 271 billion, domestic is 658 billion. Again, looking at the domestic financing, and it's something that is in the fixed income assets. We are seeing that it's an increase of around 113 billion, 119 billion shillings thereabout in the next financial year. So that already is quite negative, at least to the private sector credit growth pickup in the next financial year. So as you move to the other issue that played out last week is now the gazettement of the revenues and net expenditure as at the end of May 2021. So basically, this is the 11 months between July all the way to May. Ordinary revenue was at 1.39 trillion, of which tax receipts was at 1.31 trillion and non-tax receipts was at 80.6 billion. So as at end of May, we are just short of 156 billion to be collected ideally in this month for KRA or Treasury to meet this target for the financial year. It could be possible that it could be met in the course of this financial year, in the sense that June tax collections is usually robust, is usually steady. So there's that possibility that that target might be attained in the course of this, in this financial year. It could be attained or it could be closer to the target once the numbers come for the current financial year. In terms of the month-on-month tax receipts for the May, it was around 122 billion that was collected, slightly lower than the 150 billion that was collected in April. Looking at the gross domestic borrowing, the numbers was at 770 billion. This is inclusive of the redemptions over the course of the financial year. The target is around 958 billion, so we are shy of 200, something closer to 200 billion to be collected in the course of this month, based on the numbers that were gazetted. Recurrent expenditure is around 83% that has already been disbursed at 910 billion. Development is 71% at 286 billion, and what has been disbursed to counties is around 69% at 263.5 billion. And if you look at the public debt servicing costs, which was 820 billion, against the ordinary revenue, our ordinary revenue is at 1.39 trillion. So that's around 59% of all the monies that has been collected has going to service the debt. So it's really quite astonishing if you look at it that way. And it's squeezing out other priority needs. So you find that the balance has to be catered through borrowing. This week, rather, we are looking at the Appropriation Bill to be tabled in Parliament. So basically, this bill is now to ensure that there's that allocation to the national government. We spoke about the 1.94, 1.4942 billion that is supposed to go to the national government. So this is what will be catered for through the Appropriation Bill. What is going to counties? The 370 billion, this is a matter of the county allocation revenue bill, which was tabled in the Senate, and also the National Assembly last week agreed to that bill. So more or less, we'll see the 370 billion will be catered for. Consolidated fund services, this is a fast charge, so there's no legislative framework, at least to ensure the disbursement of funds. What is going to interest payment, what is going to redemptions of bond, what is going to pensions payment, that is a given number, the 1.32 trillion that we are seeing currently. But now the appropriation bill will specifically tackle what is supposed to go to the national government at that 1.942 trillion. Finance bill also is expected to be tabled by the Finance Committee. Its report giving its recommendation. What the CS told us is that 8.7 billion will be realized out of the finance bill. Those many proposals contained in that bill is just expected to generate 8.7 billion. So you can imagine we are moving from an increase of 181 billion year-on-year increase in ordinary revenue, but just 8.7 billion is coming from a finance bill. So that's just a drop in the ocean, around 4%. Then there's the other issue about the supplementary budget. We are in a unique scenario whereby we are just under 2 weeks to the end of the final fiscal year, but yet there's a supplementary budget that was introduced. Overall, we are seeing a net reduction of 8.7 billion in the current estimates. It started at the overall budgetary allocation to the national government was at 1.89 trillion. When it was passed last year, we had a supplementary budget late March, early April, which increased it to 1.97 trillion. So that is expected to be reduced by 8 billion to 1.96 trillion. So that should be a debate. There should be a debate in Parliament regards to this supplementary budget too, and before a supplementary appropriation bill is introduced in Parliament. So those are some of that's the macroeconomic calendar for this week. Just heavy on the budget matters. Otherwise, is light on other issues. Moving on to fixed income, we are seeing last week secondary market turnover had an increase of 29% week on week to 20.5 billion. Most of the trades still were executed on the infrastructure bond. Only that on Friday session we saw a massive activity on the 5 years space. So that is a function of the high liquidity in the market, and investors are just expressing their views on the short end of the yield curve. So ideally, the 5 year space looks quite attractive to investors. Moving on to T-bills, we saw that the overall performance rate was around 153%. That was an aggregate of 6% billion bids that were placed in the market. But nonetheless, CBK rejected a significant amount of the bids that were received. And because of that, we've seen that yields have came down even in the weekly T-bills auction as compared to the previous week. And to be specific, we've seen that between start of May up until last week's auction, the yields have declined on average 0.65%. So it's just because of the high liquidity, or because CBK is signaling to the market that it is way ahead of its domestic borrowing curve. So it's just rejecting this wide or most of the bids that are placed for the T-bills. So that's something that has played since start of May, and we still expect it to continue till the end of this month as we now roll into the next financial year. So in terms of liquidity trends, what I've just mentioned earlier on, high liquidity. So even in as much as the interbank average rate increased by 0.08% over the course of last week, we saw that the volumes that were executed were quite low, 52.25 billion as compared to 59.2 billion in the previous week. So that tells us that most of the banks that actually participated in this interbank market, but those that were squeezed out with squeezed or had some liquidity strains. So it was not something that was systematic across the whole banking sector, but it was just skewed to a few banks, hence even the volumes that were executed were low. So for us, it's just telling us that, okay, well, fine, in as much as interbank went up, still there's this massive liquidity in the banking system. And that also ties to the open market operations, the OMO, that were executed throughout last week, where CBK came, assessed the market on a daily basis so that there was high liquidity, so it had to mop up this excess liquidity by what is called the term auction deposits. And it intervened through 7 days and 14 days mainly. For 7 days, it received and accepted 16 billion at a weighted average rate of 5.3%. For 14 days, it received and accepted 15.5 billion, weighted average rate of 6.1%. So that is what is playing out, and high liquidity as we come to the end of this fiscal year. Net domestic borrowing is around 458 billion, which is roughly 85% of the target for the current financial year. The results for the month's primary bond came out last week. The market, or rather CBK, was targeting 30 billion. It received bids of 64.9 billion, and it accepted 19.7 billion. Again, back to the theme that we're talking about, that by and large, what is being signaled in the market is that the domestic borrowing target has been met or closer to be met, be it from the T-bills, be it from the results from the T-bonds that we saw last week. So the government is not even under pressure at this point in time to borrow more from the market. So that's just what is being put out there. So on one end, on the supply side, there's massive liquidity. On the demand side of the borrowing, we're not seeing that appetite by the government. So just walk you through the numbers. Weighted rate on the FXD1 2019-20 was 13.26%. That's a dirty price of 99.8. So for every 100,000 that you have as an investor, you'll invest 99,800 shillings to get into this bond. Or for the investors who bid non-competitive, they are asked to, for every 100,000, they are asked now to deposit 99,800 shillings. For the FXD1 2012-20, the weighted rate was 12.498%. So back again, still the same issue about this bond being priced at a discount, but the virtue that its weighted average rate is higher than the coupon, which is 12%. So the pricing is at a discount. So for every 100,000, you are paying less than that at 98,140 shillings. Week's trade. So because the market or investors are liquid at the moment, so and T-bills are being rejected, so the best place to express their views is on the short end of the yield curve, basically the shorter term papers. So we're looking at a buy at FXD1 2019-5 at between 12% to 12.2%. We saw last week activity, Friday session, heavily on the short end of the curve. We still expect it to spill over into this week. And then the bids that were rejected from last week's Treasury bonds most likely will now start looking at short-end papers. So that will also come in at play with our week's recommendation. So let me stop it there. I know, Damaris, you might want to comment on Family Bank, or you'll comment about it later.
I'll comment a little later.
All right, awesome. At least you are a FI guru of late. So we now dovetail to the equities. My colleagues will join in, comment about what happened last week. So over to you, Wes or Melody.
Last week, we saw the Nairobi All Share Index remain flat in the week, while the NSE 20 Share Index declined a marginal of 0.6% week on week. Turnover retreated 51% during the week to hit 2.4 billion. Foreigners extended their dominance, accounting for 52.7% of the week's turnover, they had a net outflow position and exited on Safaricom, ABIL, Bamburi, and KCB Group while accumulating on Equity Group. To you, Melody.
Thank you, Wesley. Also, for the banking sector, like we've seen, foreigners have been quite heavy on the equity counter. We've seen it's witnessed a rally over the last few weeks. Now it closed at 44.75, up from 44.05 the previous week. Now it's edging closer to its 52-week high of 45.2. So recently, it stated that its equity BCDC, which is a subsidiary it has in DRC, is set to receive a 3-year $50 million loan from the IFC to finance the small and medium-sized enterprises in the country. So we know that this subsidiary is now the second largest bank in DRC, with a balance sheet worth $2.9 billion. So Equity is not the only bank that has been getting loans from international institutions. Even KCB, Cooperative Bank, and I&M have also gotten some from them. So usually they take these loans to strengthen their capital position and also to boost their capacity to lend to the riskier MSMEs during this COVID pandemic. So at times, banks also get these funds because they face the asset liability mismatch situation where they give loans that are relatively longer term, but deposits are usually short term. So these funds, they help to plug that deficit that may come about from this situation. That's it from my end. Back to you, Churchill.
Thanks, Wes, Melody. So that's just a recap for last week, but investors, you can be able to share your questions to them in case anything that you have in mind was not covered. So in terms of where the NSE lies against the African peers, in terms of price to earnings ratio is slightly higher at 14.3 multiple against a median of 11.9 multiple. A dividend yield is lower, 2.2% against 5.1% African median. So getting on to the week's calendar, Friday session, book closure date for Total Kenya, 1 shilling 57 cents, and also Umeme Limited, that's 12 Uganda shillings, final dividends. Books closure slated for this week on Friday. And also AGM for Nation Media, the share buyback shareholder approval slated for this week on Friday. If it's approved, starting from next week, Monday, the management of NMG will buy 10% of the outstanding shares for NMG. So it's something worthwhile to look for the results that the shareholders will whether they'll either approve or reject this particular proposal. As at the end of last week, NMG was around close at 23 shillings and 10 cents. So it's roughly 8% of the maximum share buyback price of 25 shillings. We saw rally in the first week after this final details of the share buyback was released to the public. But after that, it's more or less ranged between 22 shillings and 80 cents and 23 shillings and 10 cents. So quite worthwhile to see the price action after this AGM over the course of next week. Week's trade, looking at ABIL, a hold on the counter, basically is within our target price. Last week's close was at 189 shillings. Our target price is at 194 shillings and 32 cents, so it's roughly 2.8%. We expect the mainstream spirits to have a stronger performance in the upcoming FY21 results. So that's just the end of our presentation, but happy to take your Q&A. In the interim, Matthew to walk us through the global markets. Matthew, morning.
Hey, good morning, everyone. Let me share my screen and we have a look at what we have on the global markets. Just a second. Okay, so let's check out on the global markets what we have. We start with the last week's recap. There was the FOMC meeting last week, and the Federal Reserve signaled it might increase the interest rates twice in 2023. Remember, part of the things traders have been waiting to hear is how the Feds are going to deal with the rising inflation, and now the response has started to come up after quite several weeks of indications of rising inflation and a little bit better performance of the economy. So Fed signaled it might increase the interest rates. That one spooked the market quite much. That was in March. And what happened with the Dow Jones? It fell to its lowest levels in a month. US dollar hit a 2-month high. The index hit a 2-month high. And as a result, gold was able to plummet or fall to a 7-week low. From the UK side, there was a 1.5 rise. Okay, there was a rise of 0.6% of the CPIs from 1.5% to 2.1. That's one again, rising inflation in UK. And that is the highest reading since 2019. This is likely due to the rising cost of commodity prices as the demand is increasing. Of course, remember that UK, there is a better performance in terms of the uptake of the vaccines. They are coming up to par, and that's what is contributing to the increasing demand of the commodity prices and even the rising inflation. Oil as well was able to hit a new 2-year high, above 70, 71, 72. And the week, it hit a high during the week as the recovery assisted the market. That is the recovery of the economies, and there's more demand of the oil. So the energy was pulled lower by the firmer US dollar and general risk of attitude after the Fed meeting. So here we've looked at 2 commodities, oil and gold. Remember, all these commodities which are priced in terms of US dollars, whenever the US dollar gets stronger, then they're likely to get a sell-off because they become more expensive. That is for last week. Now, moving forward, the economic calendar, not quite busy, but we have PMIs that are really going to support either the rising recovery of those economies. And already Australian retail sales came up, and it's worse than expected. If you check out on the Australian dollar USD, even as we have a strong dollar, buying of strong dollar and selling of the Australian dollar, still the poor performance of the retail sales has sent the Australian dollar USD even lower. So still we're expecting today to hear ECB, European Central Bank, Lagarde speak, and still we have members of the FOMC from the US side speaking, and they are likely to give more directions into the monetary policy. On Tuesday, Fed Chair Powell testifying, Bank of Japan, something for the Japanese yen. On Wednesday, we have quite several PMIs on the US and UK, even the euro. So those ones are really going to increase some volatility in the market. That's something that traders would wish to check out for. And for the traders, for the enthusiasts of oil, US oil, we have the oil inventories. Last week, we had the inventories really go down, right? So we're waiting to see what happens on the inventories as well on the US to see the opportunities, whether there's increasing demand and the likely change in the prices so that you can take opportunities. On Thursday, monetary policy from England, there's quite a lot coming up from the side of the pound. You can see the US final GDP quarterly, BOE on Thursday, monetary policy. Still, check out the flash PMIs on Wednesday. So pound is something to watch during the week. On Friday, quite a lot for the US PCE, that is personal consumption expenditure. Total is coming amid the government coming in to rein on their purchases, then the personal income and consumer sentiment. That is likely also to go to make dollar a little bit volatile. That is on the economic calendar. Again, remember to use the one that you like most. On the side of the earnings report, Plug Power, FedEx, and Nike, check out on those for the ones who are trading on these stocks or the ones who speculate on the stocks. The dividends, companies which have got dividends due, announcements, Broadcom, of course, that is their expected dividends. So you wait up to see what they're going to give up as their actual dividends value, right? Dividends price. So if you trade on these ones, check out on how the news come up. Monday, Wednesday, Thursday, we have quite of them there. We have Vodafone Group, PLC. You know, Vodafone is related to Safaricom here. So I don't know whether there's anyone who trades on them. FedEx and Catered Global Corp, Broadcom. So check out on those so that you can find the opportunities. So this week, the financial instruments that we want to look at is the Dow Jones. And looking at the charts, you see that there's been on quite an uptrend since the beginning of October 2020. It has been bouncing just along the 50 moving average, but because of the strength of the dollar, you have seen the US 30 break below the 50 and the 50 moving average. When you check out on the oscillators, it's oversold. Yeah, this is on a daily time frame, it's oversold, and the momentum is really downward. So looking at this one, traders would want to check out whether it is going to maintain above that 33.2. If it builds a strong base around that point and still move up above the moving averages again, might be an opportunity. That would be a good opportunity for traders to get in for a long position. But currently, with this bearish momentum here, there might be a downward movement all the way to 32.123. That's why we have the next support, which has been a previous resistance level. So that is what we have on the US 30. The other financial instrument we want to look at is, let me check out on the gold. Gold, of course, gives opportunities whenever we have movements on the side of dollar, because it is priced in terms of dollars. So looking at gold on the 4 hours, it has really shed part of the gains it had made since May. All along May, it has been an uptrend, and we can see that that uptrend has already been broken, and right now it is on lows of 1760s. Around 1762 has got some support there. So looking at the oscillators, you can see it's getting off the oversold levels, that is on the 4 hours. On the daily, it's still, yes, bouncing off on the oversold levels, and the momentum is quite bearish, trading below the moving averages. So if gold is going to maintain this base at 1762, then traders will be looking to see whether it's going to break above the 1800 level, because stability above 1800 levels is what is going to open up opportunities maybe for a further upside all the way to around these levels, 1820s, 1830s. That's why you find another area of resistance. But if in case it still continues slipping lower and lower, then the next levels will be at 1726. And then if it still breaks below that level, then we might get the price going lower even to the lows where we had that double bottom at that point. So currently below the moving averages, it's on oversold levels, but it's stabilizing. But traders need to watch and see it stabilizes above the 1800 for further upside. Currently, for short positions, positions, short-term positions, maybe you might want to see anything above 1793, maybe targeting somewhere around 1800s and 1825. And that's it from my end today. So over to you, Damaris, for Q&A.
Thank you, Matthew. How are you today?
I'm doing good. How about you?
We're keeping well, thank you.
All right.
We have a couple of questions for you, Matthew, so we could start there. We have Ian Wanjai who's asked, are there any solid stocks in the offshore markets which are trading at affordable prices other than the likes of Apple and Tesla that someone can look into?
Well, when it comes to stocks, I cannot actually point you to a specific stock, but how about check out on the indices? For example, when you look at the Dow Jones that I've just talked about, I'm checking out for that chart. So we have had quite some nice moves on the indices, like on the US 500, it is an uptrend. And what happened after the US dollar farmed, we had a very strong pullback, and that's a downtrend which has just farmed at around 41.37, getting some support around that level. So when you go to the Dow, let me pull out the chart for the Dow quite fast. US 30, looking at Dow again, it's still getting a support around 33.027, still a downtrend on that. So I cannot point towards a specific stock currently, but look at the indices and you get some quite good opportunities.
Thank you, Matthew. So maybe not particular stocks, but you do recommend a couple of indices. Thanks for that. We also have a question for you that came from Kamau. Kamau wants to know, how does one get into the Chinese stock market, considering it's going to be an economic superpower?
All right, that's a good question. I have to share the screen so that I show you all that. So on the Chinese market, you can trade on their index, all right, or even trade on their Chinese yuan against the dollar. So we have several indices. Let me point you towards the China 50 roll. Okay, you can find out there. We have an index that you can trade on the FX Pesa platform, right? So it has been on an uptrend all along, and this is because of the increasing and better relationships with the US. And you can find out there's a good uptrend there still, but the strengthening of the US dollar again, making it to pull back a little bit. So you can trade on the China 50 roll, or you can go to the US dollar against the Chinese yuan. So there are good opportunities. You can find on those two financial instruments and speculate on them, or even find out on stocks that are listed from the Chinese side.
Okay, thank you for that. And hopefully Kamau has taken note of those three options available. You're on a roll today, Matthew. There's one final question from Alicia. Alicia is asking about your FX Pesa app, whether NASDAQ is listed.
All right, a good question again, and I will explain that by pulling out the NASDAQ chart on our platform. You will find it as UT100 roll. Here it is. If you can see the chart, still it's been trending up since March 2020. It seems not to have been much affected by the farming of the dollar that happened previous week, trading above the RSI, above the 50 level of the RSI. A very strong upward momentum there, but it is on its highs, okay, on its peak and on its highs. So yes, we have the UT100, that is the NASDAQ. You can check out there. So long as it's above the moving average, is fine for a good place for entry. Right now, it's at 14,062. If it just rises above the moving average is there, then of course you have good opportunity to like speculate something to the upside, maybe aiming at the 14,200 levels, because beyond that level, then it's likely to keep moving higher. So yeah, there's the Nasdaq. You can still speculate on that one.
Asante sana, Matthew. Elisha and everyone else who's interested on trading in FX Pesa, as Matthew has mentioned in the past, the app is freely available, as well as training sessions to get you started on the global financial markets. Thanks, Matthew. Let's go further to other questions that came in earlier. So Daniel Ariba said, Churchill, you mentioned that domestic borrowing target has already been achieved for quite a few months now. Hence, the government is trying to promote long-term bonds. Are we likely to see an end to the T-bills, or will they always be there, but with unattractive interest rates? Churchill?
Yeah, that's a good question. And what has been announced by the government, or rather, is it the government, that over time they'll be able to reduce. They are targeting to reduce the stock of the Treasury bills. I think specifically there's a report they tabled in Parliament saying that from the start of this financial year up until I think end of April, thereabout, they managed to reduce it by 140 billion. So the thing is at least to reduce this refinancing risk, because with T-bills, they mature within 1 year. That's the maturity. And it now brings this issue to do with refinancing. So in any given financial year, you find that the redemptions mainly is coming from the domestic debt market. So to reduce that refinancing risk, there's this overall medium-term debt management strategy, at least to have the longer-term papers. So that is what is currently at play at the moment. And yes, I've been mentioning about that from where the government is sitting, it's way ahead of its domestic borrowing target, or it has already met it, or it's right ahead of it. And this is stemming from the fact that the statistics that we received from the government Treasury as at the end of March, domestic debt was around 460 billion. I remember I mentioned a number which was quite conservative, basically because over and above just borrowing through Treasury bonds and treasuries, the government also borrows through other means, which we don't have some access information. Now, if we add the additional domestic borrowing routes into the statistics that we track on a weekly basis, it's right ahead of the domestic, it's right ahead of its, or it's more or less has hit its domestic debt target of 500 billion. That has played out with the rejection of Treasury bills and also the Treasury bonds that we saw. So going forward in terms of our outlook, and even the recurrent budget books for the next financial year, specifically the domestic borrowing will be 100% Treasury bonds, not Treasury bills. I don't know how exactly it will be done, but that's what they have signaled to the market. At some point, I can share that snippet so that you can see it. But that's what they've been said. So I don't know whether I'm not too sure whether they'll not be domestic Treasury bills in the next financial year, or rather they'll just be using it for liquidity management purposes, because I don't think that they'll completely pivot away from not having weekly Treasury bills. But I think by and large, as per what Daniel has stated, perhaps just reject or ensuring that the bids are not as attractive for investors to go over there, or they just reject many bids from Treasury bills such that they just manage the rates. That's just my view around it.
Thanks, Churchill. That was very clear. Still on borrowing, Eric Ombok had a question about the Eurobond. So Kenya sold the 12-year Eurobond on Thursday at 6.3%. What is your expectation on the yield during trading this week?
Oh, interesting question. In fact, I didn't even mention about Eurobond at all in my presentation. But anyway, yes, the Eurobond was issued last week. The 6.3% we understand is the coupon. We haven't seen the final pricing as per that sale that happened. But indicatively, the prices was around, because I saw a figure around 99.991, which is around closer to 100%. So that tells us that the yield when it was issued was slightly higher than 6.3, perhaps 6.31 or whatever it was, but it was closer to par. So what's the outlook for the trading this week on Eurobond, on that particular Eurobond? One, looking at the amount that was accepted, $1 billion out of $5.4 billion, that was the book building, or the book that eventually the Treasury told us that it managed to get. So we are seeing that there's $4.4 billion being rejected out of the monies that was now finally accepted. Of course, right now, it's just a matter of doing the bid allocation, or it could be proportionately, or it could be depending on the rates that individual investors bid in. But from a demand perspective, I expect that because of that significant amount of bids that was rejected, perhaps some of the investors who really wanted to get into this Kenya 34 Eurobond might now come in and see that the yields are going lower than that. So the overview, my expectation is that we're likely to see the yield states trading. What's the term? I'm trying to get the correct term. The yields will be lower than the 6.3 that came out last week. So expect pricing between lower than 6.3% once the papers trade over the course of this week on a high level thinking.
All right then, thanks, Churchill. Let's move to equities, and we have a couple of questions touching on different stock. The first is also from Eric. He asks that the hold on ABIL, is it a change from your previous recommendation? And also, I believe I saw Monica ask a question related to ABIL. She wanted to know what has prompted international investors to exit from Safaricom and ABIL and other counters. Would Melody or Wesley attempt this question?
Yeah, the recommendation has changed, but it has changed against the uptick of the share price, because as of 29th January, the recommendation was a buy with the same target price, which represented the potential uptick of 31.2%. But as the share rallied and its price went up, you see the target against the share price rallying makes the potential uptick go down, which led to a change in recommendation, which shows that the counters performed well up to expectations during this period. On the second,
Wesley, I think you're having some internet connection issues.
Yeah, Wesley.
Churchill, perhaps you could step in, because I heard Wesley's first answer that for ABIL it was a move from buy to hold, but the rest has kind of broken up.
Yeah, so let me just reiterate what Wesley has said. Sorry about that. Well, sorry about that technical hitches. So just to reiterate what Wesley has said, the buy or the change in recommendation is not that the fundamentals have shifted. It's just we're looking at the current market price against the target price. By the time you're doing the playbook, the price was the upside to the target price was above 15%. So that was the justification of a buy on ABIL. But you've seen the counter at least rallying gradually over the course of this year. And right now it closed at 189 shillings as at the end of last week. So that's roughly 2.8% of its target price. So that's where the whole recommendation comes in. So just to give you some perspective, our sell recommendation is whether there's upside of negative 15% or rather a downside of 15% and greater than that. And anything between negative 15% to 15%, that's where the whole recommendation is. Anything above 50% upside, that's where the buy recommendation is. So basically, we're just looking at the numbers ahead of the release of its full year results that will be end of next month. So that's where our estimates buy recommendation is. Also, that I think ABIL, of course, next week, they are doing the early redemption of the MTN medium-term notes, the 6 billion that was still outstanding corporate debt segment. So that is basically their liability management strategy just ahead of its maturity. This paper was supposed to mature next week or next year in April, but now they had chosen to retire it a bit earlier. That said, the management said that they are still looking at coming back to the capital markets sometime. They didn't give a framework, but they said that they are not entirely exiting. It's just that because of their balance sheet management, they chose to retire it a bit earlier on. So that's the other issue around ABIL that investors are looking at ahead of its early redemption next week on Monday.
Churchill, what of Monica's observation about international investors exiting counters like ABIL and Safaricom?
Oh yeah, sorry, I forgot about that. From international investors, majorly we're looking at institutional investors, pension fund in the US, UK, South Africa, or wherever. And majorly what dictates the investment decision is on a two-front perspective. The first one is currency moves, which also influence the returns they'll be able to get. For instance, if the shilling depreciates slightly against the dollar, that the dollar is now their investment currency as they come to Kenya. So if it depreciates slightly or significantly, it's a positive on them. So they gain on the currency moves and they can be able to exit. Secondly, is also the returns, basically the price appreciation or dividend income. So specifically for ABIL and Safaricom, at these levels, we've seen that on a year-to-date basis, they have gradually rallied or increased their share price. So what, from their perspective, they need some triggers. Remember that from what institutional investors look at, they have a portfolio that they are managing. Say they are looking at a portfolio of 3 stocks and say they have allocated 40% is going to Safaricom. And because Safaricom price has rallied from the start of the year, theoretically, up until right now, so the allocation or the portfolio weighting for Safaricom is greater than that targeted 40%. So what they need to do, they need to rebalance it to take it back to 40%. So this concept about rebalancing. So those are the things that play out. So by and large, I think that the exits we've been seeing in Safaricom, ABIL consistently against the current pricing is basically dictated by the rebalancing by the portfolio managers or the foreign institutional investors just based on the price action of the respective shares. So that is playing out, but as foreigners are exiting, you find that even locals are coming in to take up the role of the exiting foreigners. So that's what's been playing out. Broadly, rebalancing effect and also the currency moves, which dictate triggers for foreigners to exit the underlying stocks.
Thank you, Churchill, for the insight into institutional traders. Kamau had asked a two-part question, and the first was addressed by Matthew. His other question was about BAT. He observes that in 2016, the counter was trading at 1,000 bob, but it's now at 450. What halved the price? Why the decline? And does that make it a discounted counter?
Well, let me take that one. Interesting observation, and a number of things are at play here in regards to BAT's price action. One is the consistent taxation proposals. We had Tax Control Act or some, I forget the name, which was a broad-based taxation proposals on tobacco, which had a negative impact even in that industry. We also have illicit trades which have been a negative on tobacco. We have competitors coming into the market, competing against BAT Kenya, and also what else? The markets that they are relying. BAT Kenya not only produces for the Kenyan market, but it also has regional exports market, be it DRC, I think South Sudan, or which other market it is. But because of the geopolitical risk or the risks in those export markets, it has had a negative impact on BAT Kenya. So all these fundamental issues have had a hand in that gradual decline in BAT's price from 1,000 shillings, as correctly mentioned, in 2016 up until where it is right now. So basically, the market is discounting it based on the negative fundamentals facing the tobacco industry as a whole. And yeah, just to sum it up. And specifically for BAT, I think its free float is around 40%. Basically, the 60% is held by the company, the parent company. So the only trades that it's not as liquid counter as it is. So you find that even one guy or a retail investor can be able to lead to that spikes or that decline in the BAT stock price. So I think let me stop it at this point, Damaris.
Okay, Churchill, thank you. I want to save Joseph's question for last because it seems like it'll require quite a comprehensive response. So let me hop to John Kamau's question. Earlier, you'd actually raised the Genghis playbook from January. So John notes that in the Genghis playbook, KenGen was recommended to reach higher values of 6 and 7, but that's not been the case. What are your views, Churchill?
Oh, sorry, I was a bit distracted. Yes, our recommendation for KenGen was those levels that have been pointed out. But having said that, and also what we put out in the playbook is the major risk for KenGen is its KPLC. It's tied to KPLC, and that has had a negative sentiment on KenGen, despite its revenue diversification, despite its getting into some other markets outside Kenya, be it selling of sales into Ethiopia, and also getting some drilling rights in South Sudan market. But the biggest risk is now on Kenya Power, by and large, and this is something over the long term that will see at least reduce this specific risk is this kind of reforms that are being proposed by IMF. IMF had flagged Kenya Power to be, at least to be restructured or to be part of the broad-based state-owned entities restructuring processes. So that will be a positive, not only on Kenya Power's prospects, but also on Kengen's prospects. The other issue is also the World Bank loan that was extended or approved as at the end of by last week at the $750 million. Again, one of the proposals that is being earmarked to be embarked by the government is this issue to do with the reforms to the Kenya Power. So from those two fronts, if they come to fruition, at least it will be able to de-risk Kenya Power's concerns. It has higher cost based on these unattractive IPP models, independent power purchasers models. So we think that if those two reforms bear fruit, it will de-risk Kenya Power, and ultimately people will not even see Kengen in negative light as they are currently seeing it. So that's just a long-term thinking in terms of that anchors our price level between 6 to 7 as per the playbook.
Sawa, Churchill, well understood. Monica's question was, would you advise someone to trade in bonds at a discount or premium? And what factors does someone have to consider in both those cases?
Interesting. So for those not in the know, there's usually an inverse relationship between the coupon price and also the yields. So if a coupon is say 10% and the yield is at 11%, that price, the bond's price is at a discount. So basically for every 100,000, you'll be investing below 100,000. And for vice versa, if the coupon is higher than the yield, the price is at a premium. So basically that's the crux of the question. So ideally, a number of factors come to play in this instance. Demand and supply factors, there could be some papers, even specifically you're looking at a paper, 3 papers that are maturing in 5 years' time. One of them is priced at a premium, one of them is priced at a discount. So chances are the paper that is priced at a premium, perhaps it has a higher coupon rate, or it's quite liquid as compared to the one that is priced at a discount. So there are different factors that are at play here, but it comes down to individual investors' prospects. Are you looking for a longer term paper, longer term maturity? Are you looking at a higher coupon price? So ultimately, you'll find that even this dichotomy between premium or a discount does not matter. You'll just end up paying, because ideally, the discount and the premium is what you will pay to buy that paper. Say you pay at a discount, so you're paying below an amount lower than 100,000 theoretically, or if you're paying at a premium, you're paying above 100,000 theoretically, but you still get the coupon rates, your semi-annual coupon rates every 6 months up until the end of the life of the bond, but you'll get back 100,000 at the end of the paper, at the end of the life of the bond. So ultimately, it's just the entry price is what we talk about, the discount, the premium, or from a seller's perspective is what you will ideally get if you sell that bond in the secondary market. So ideally, it's just the entry and exit levels that you're talking about, but the other factors come into play depending on your investment horizon, depending on what you are looking at, depending on the coupon you are seeking, whether it's an infrastructure bond, which is tax exempt. So those other factors are secondary or also determine which bonds specifically to enter as an investor.
Churchill, thank you. That was a very comprehensive answer. So I think we'll come to the second last part of the this Q&A by addressing Joseph's question. So it's to you, Churchill. His first part is, could you kindly contextualize the budget presentation a bit more for an investor to know some specific aspects that will affect investment operations? This is in terms of returns and risks. For instance, one, are there any tax policy changes arising from the budget that investors might want to note? And two, are there any sectors of the market that will be affected in any specific manner by the budget proposals? I really like this question. So Churchill, ears are open.
Okay, well, it's such a broad question, but let me just attempt to answer the question. Let me just see what best way, because let's just go with the numbers that we have. Just a second. Just a second. Yeah, so this is the broad budget framework that we have. So if I get Joseph's question, we are looking at two perspectives. So the first one is now on the tax policy changes. And then the second one is now which sectors will be affected anyway. So on the, let me start with the first one. On the budget policy, tax policy changes, tax policy changes. So for the next financial year, we're looking at an increase of 181 billion in terms of the ordinary revenue. But then this increase in ordinary revenue, you can see the 1.78 trillion, the ordinary revenue target. That's the increase of 181 billion. But what even the CS mentioned last week, no, the other week in his presentation, is that the finance bill will just realize 8.7 billion. So this increase of 181 billion, 4% of it is just coming from all those tax proposals that were made in the finance bill, which is slightly lower than ordinarily. The previous financial years, you've been hearing figures of 35 billion, 37 billion, or 40 billion. But right now it has come down to 8.7 billion. So the balance ideally is just based on a recovery in the growth for the ordinary revenue. Ordinary revenues, income tax collections, VAT, excess duty, and whatnot. So I'm not seeing anything that could move the needle in terms of the tax proposals being that have been fronted that will have a massive impact. Just the quantum that we are looking at, 8.7 out of the 181 billion increase in ordinary revenue. So that's one. But having said that, the finance committee will be tabling its report ideally tomorrow, and in its analysis of the finance bill and as it gives its recommendation. So that's one thing. I don't know whether that answered the question. As I said earlier, this is a broad question. But having said that, there are some pockets of proposals that have been highlighted by the not only by the media, but also by the tax experts, things to do mainly with the VAT, things like taxation of bread, taxation of needles or baby formula, but specifically for the markets, there are those changes of in the income tax, rather than looking at the capital structure, they're looking at, I think, changes to do with EBITDA proposals. So, but I'm not the tax expert over here, but majorly, we are not seeing meaningful impact that will come out of these proposals as just based on the numbers we are keeping an eye on. So based on the other question, expenditure, which sectors of the market? Budget proposals, well, this is now on the expenditure side. The second part of your question, on the expenditure side, we're looking at actually we're looking at a slight decline in what will be spent by the government, 1.94 trillion in terms of the budget expenditure. So the sectors still is still a bit fuzzy, if you ask me, in terms of which beneficiary sectors will come. Remember that the government spending is around 14% of the overall GDP in any given financial year, rather in any given calendar year. So, but we haven't seen that much of a spillover effect in the sectors in the economy. So that's why at this point we are seeing a neutral effect broadly. Having said that, this economic recovery strategy that the government said will implement, at least to take Kenya out of into the next phase of tackling COVID-19 pandemic, is still fuzzy. And then there's been bits and patches of proposals here and there, which is not even quite coherent, if you ask me. And we are not seeing that spillover effect into sectors. On a taxation basis, of course, BAT, what you mentioned earlier on, is expected to have a new additional tax burden, taxation on lifts. ABIL over the weekend, it mentioned that despite the inflation tax adjustments that was made in 2019, last year there was none. They did not readjust their prices. But over the weekend, they said that they will now readjust their prices accordingly. So that will also be something that investors will keep an eye on this particular sector, which are heavily taxed in the market. The other sectors, such as banking, the issue around pending bills, the CS mentioned that counties needs to settle their pending bills by the end of this year. End of this financial year. I don't know where the amount will come from. Even the numbers we saw, the disbursements to counties is around 69%. So I don't know what where the monies will come from, at least to settle the pending bills. But by and large, the banks themselves that have been talking about pending bills as a major issue, are not pending bills, the NPLs have risen because of the pending bills by the government not settling the arrears to the private sector. But that being said, is something that has already been priced in the market. So it's not something that is quite new, to be honest, to influence majorly the sectors in the market. So just to answer you, just to connect even the NSC, how it is structured, we have two sectors accounting for 80% of the market capitalization. So, and those two sectors are not even impacted broadly by the reforms, be it on the spending side or on the taxation side. So it will have a neutral impact on equities largely. For fixed income, this issue around net financing, you can see the net financing, domestic financing is going up by 600. It's going up to 659 billion from 544 billion this current financial year. Of course, that will squeeze out private sector borrowing, and it will have a negative impact on banks to some extent, or the net interest income, or rather, as opposed to banks now robustly having credit mediation, they'll now look at the government securities in the next financial year. So that will also have some impact even in the fixed income markets. And we're just waiting to see what kind of long-term papers will be issued in the next financial year. So I hope that I have broadly captured that question.
Thank you, Churchill. You've done a good job. Before we conclude, there's a question here for Matthew from our YouTube live stream. It's from Peter Mwangi. Peter is asking, how is positioning size for indices and commodities done? Is there a calculator you could recommend?
That's a good question. So when it comes to position sizing, it's more the same. It's like the same way you would do for the currencies, but there's a simple way of doing the position sizing. Of course, you know, for the commodities that they're a little bit more volatile, and the pip value for every small movement might be a little bit different. So the way we would want to estimate the position you're taking, for example, the lot size, because you're basically speaking about the lot size, it's find the difference between where you're entering the trade and where you're putting your stop loss. That is your stop loss pips. Once you get the stop loss pips, then how much are you risking for every single position? For that position you want to take, how much are you putting into risk? So if, for example, it's $100, and that distance is going to be like 50 pips, for instance. So what you're going to do is have the stop loss pips, yeah, the stop loss pips, and then you factor in the amount of money you're going to lose for that particular distance. So it's basically based on the distance that you're taking for the stop loss.
All right then. Thank you, Matthew, for that answer. I believe we've come to the end of our Q&A, and before we conclude, I just wanted to touch on the family medium-term note again. We went through this comprehensively last week, and Churchill really shed great light on it. I think my duty here is just to alert everyone that there's just one more day left to take up the offer. So the offer closes tomorrow. Again, the minimum investment is 100,000, and the fixed rate, there are two rates. There is the fixed rate and the floating rate, and Churchill walked us through the ceiling and the ceiling and the floor for the floating rate last week. The fixed coupon rate is 13%. It's payable semi-annually with the first interest payment expected on December 24th. So if you're interested in taking up this opportunity, it's a rare opportunity for retail investors to participate in the fixed income at such an attractive return and with a minimum investment. Just reach out to our team on Corp Finance at genghis-capital.com or call us on 0709-185-000, or you can just reach out to us on our social media pages and we'll guide you accordingly so that you're able to participate before tomorrow's closing dates. In case you have any questions, like I always say, we are accessible via email, via social media, so feel free to talk to us. Thank you. I know today we had a very robust discussion, and that was thanks to the really great questions that all of you shared with our panel of experts. We truly appreciate it. We also really appreciate our research analysts here. Matthew, thank you so much for taking over an hour out of your Monday morning. We really appreciate your insights and for you addressing the different questions raised. To Churchill, Melody, and Wesley, thank you as well for walking us through the Kenyan financial markets, the opportunities, and for going that extra mile in terms of answering the questions that were raised by the team. We are very glad to see everyone who stayed tuned to us, and we'll meet next week on Monday. Have a great investing week and stay safe.